Hey everybody, well, we've got some big data to share in today's video about what we're looking at for the next coming months in the stock market and markets around the world. We've also got some things to discuss about this red candle that occurred after what was a bit of a disastrous week. Is it the end of the bull run for now, or is there something else just around the corner? Stay tuned to find out more. Okay guys, well here begins our recap of the markets, and we'll talk about the technical analysis levels for the S&P 500, Nasdaq, Bitcoin, gold, Tesla, and of course the dollar index throughout today's video. And firstly, we'll start here on the heat map of the S&P 500. And I just wanted to mention a few things I see straight away. Semiconductors down, FANG stocks down, but more importantly, banks and energy sector down. And then after that, you'll notice that there are some greens, and we'll talk about them in just a few moments. So what happened? Well, we had the CPI data. What was it? It was not a hit, it was above expectations. And we've talked about how we want to hit, so exactly what they expect, or a slight miss. Now, we got an above expectations. It looked like the fake market futures, the futures coming into the open, were going to open green. They did. And then unfortunately, we saw a sell-off into the close of the day. Now, should we be worried? We'll be talking about that throughout the video. But firstly, we're seeing more rotation into defensives, utilities, healthcare, XLV, consumer staples, even the water sector. All of these were the ones that were performing best for the day. And this makes me know, and we all know this, that when Wall Street starts grabbing utilities at definitely not the late cycle of this new bull run in the markets, then we need to be paying some attention, and we will be, and we'll be breaking down a lot of those figures. So let's have a look at earnings season this week. Yes, we're in earnings season, and we had the banks, and now we've got the beginning of the big companies coming out here. We've got IBM, we've got Netflix, one of the FANG stocks coming out. We've got Coca-Cola, Intel, Snap, American Express. Plenty to look at this week and plenty to break down. Now, we talked about how we could be in a buy the rumor, sell the fact kind of event. And what that really means is it means that all of these stocks have been running in, specifically things like Nvidia, go have a look at it. Apple, go have a look at it. The stock is going crazy up. And usually when a stock goes crazy up, we've talked about how the expectation of Wall Street is that you don't just hit the level. You need to smash the level out of the ballpark. So if their expectation, let's call it a 5, is a 5, they will want, if we go up to a 10 up here, they'll want at least an 8 out of those stocks to be able to even hold the price. And that's why a lot of people don't understand that when a market sells off after what looks like a great earnings, it's generally because when you look at the price action coming into it, it's had a run months ahead or a few weeks ahead, etc. Always pay attention to that. Super important. There'll be quite a lot of tells as well here, I believe, for if we are going to get a bigger pullback coming through. So firstly, I mentioned this and I signaled this in the Thursday video that we did on the channel here. And I spoke about the fact that this guy Martin's data, that is Martin, his name is, that he was doing data for the Russell 2000 and basically had this new high, new low concept, and that it only triggered a few times. September 2014, July 15, October 18. Now, I remember October quite well. And what it signaled was that over the next 3 months, we would have a market that was at least 10% lower. Now, I believe this is actually a relevant statistic, and I don't usually bring up some of this mumbo jumbo stuff to you guys on the channel because when I think about it, it just doesn't make that much sense. And you want to really cut through, I guess, for the lack of a better judgment, crap when it comes to breaking down technical analysis, breaking down fundamentals, breaking down data points. But I do think it makes sense to look at the Russell right now where we know it's run up. And if the Russell is weakening, there is a sector that we should always be looking at before market crashes. And we'll take a look at that throughout today's video. Let's start with the technical analysis. Let's have a look at the dollar index first. Wowzers, that thing closed strong. Look at this, 92.70, put a lot of pressure on gold, which we'll cover in a minute. But yeah, big closure here. Now we look for a breach of this resistance, and this is a very strong signal that risk is off the markets, at least from the way Wall Street is looking at it. When we take a look at this picture, what does this tell us? We've had a lot of body closes around this point. We got effectively a shooting star or pin bar rejection candle over here. and we've almost fully reversed that. Once you start breaching past this previous peak or high over here, you know what that does? It takes out all of the stop losses for the short sellers, and that in turn generally leads to further bullish movements. There's a lot going on here in the dollar index chart. Let's move over to TLT, and this is the 20-year treasury bonds. Now, a lot of people are going to say, oh, Tom, head and shoulders. Yes, I see it, guys. But remember, a head and shoulders is only really active when it gets all the way down here and breaks through the neckline. So what we're looking at here on the 20-year bonds is it's increasing. And this basically means that, again, there's a rush, and the bond market is smart, even though you guys don't think it is smart. And when there's money rushing in, which we've been talking about now, and I will continue to hammer this in, when the bond market's going up and the other market is also at all-time highs, e.g. the S&P 500, we need to pay attention, because if we're hitting near the tippity top and bonds are going again, there is something very wrong in the markets, and we need to be absolutely paying attention to that and really positioning ourselves to take advantage of that in the future. I've always talked about how you need to have a plan, and I think we'll do that on the Monday session, the Monday live stream, 1 hour before the New York Open, where we'll go through some of the things that you need to think about to make a plan for potential crashes or potential pullback corrections in the market. So we'll start off here with gold as well. What's going on there with gold? Basically, the bond side, by the way, is just we're looking at the bullish movement here. We want to see it break past this 149, and then I think that will signal to the 155. So effectively, we would get further strength here. We'd crack this high, we'd then break through and then move to the 155. Now, this 155 move, if we still hadn't fallen in the market at that stage, I would be very, very careful, because this is a signal, again, risk off, low volume in the market from Wall Street, only retail traders left holding the bag, for lack of a better term. Let's go over gold. We've got, of course, resistance, 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 and then support. Now, this had another pin bar that then failed on the 8-hour, one of my favorite timeframes for gold. Very unfortunate that the dollar index is strengthening so much. Is gold gone yet? No, I guess not, from the perspective of there's a lot of structure around here. This is where we saw that breakout occur, but this is definitely not a very good thing. And for anyone that's trading these kinds of pin bars, remember, wait for the momentum follow through. If there's no follow through, these are massive traps, and they're designed specifically because Wall Street know you love the hammer, you love the pin bar, guys. We all know everyone trades these as retail traders. They design this trap to take your money. So always wait for the further momentum follow through. Let's have a look now at Tesla. So Tesla is back down on the bottom of the trend line. We've had now 4 touches of this. We've obviously got a touch over here. I'm not really feeling that bullish on Tesla until we get back above 660. I was hoping the Friday session would bring you guys some bullishness. We could see it started off well here with the close of the session having a rebound. We had a little bit of green, and then the rest of the market drove Tesla down. But it's not over. It just needs to hold really around here, or this 630. If it doesn't hold that, I'm really worried for Tesla. But at this point, yeah, 660 plus closure, well, that will signal a nice little pull up through this, effectively a lightning bolt on the smaller time frames. Let's go down to the 1 hour so you guys can see that. So really what you'll have here is you'll have like a trough, a peak, and then hopefully a higher peak kind of coming through off the trend line. That's going to look good. That's going to be the kind of bullish momentum that you must have to get this trend back and started again. We'll move over to the QQQ. So this is the Nasdaq for anyone that doesn't know. And wow, it was a bit of a sell-off there, wasn't it? Our 4-hour 20 exponential moving average that we have followed now for many weeks and bought dips through didn't hold up. And there were some signs that it wasn't going to be able to hold up. Unfortunately, what happened was it rallied and then could not get a new high. So as soon as it broke underneath here, of course, it signals even further selling. And actually, this kind of signals all the way back down to this support here and this resistance to put pressure on the downside. That's what you're looking for here on the Nasdaq. Let's have a look at the 4-hour again. See here, 4-hour resistance, support, and more importantly, when you go to the daily, 20 exponential moving average. So I would not be surprised at all to see the Nasdaq come down to this level, find buying pressure, and hopefully that will be the end of the movement down and at least some more rallying into the earnings. Let's just think about a scenario here though. We pull back, we go up, the bears come out of hibernation and they pull it back down. They close under the 355. If they do that, they have created a peak, a trough, a lower peak, and of course a lower trough. The sequence is in play on a daily chart. If that occurs, yes, the market will be going further bearish. That's a price action pick. And effectively, it is at least predicting down to a 342. And I've spoken about how I think that this pullback at least goes to the 20 exponential moving average, which is down here. In terms of how far away that is from current price, about 5.54. I could see it going even further at some point. That's definitely very possible. And this is the zone where it will hit the 20 at the same time. So remember, it's all orchestrated. These types of pullbacks are all orchestrated. Pullback, 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 all the 20, all the time. So that's the area that a lot of people are going to be looking at on the weekly for the Nasdaq. I spoke about the most important sector. I talked about the banks and how my eye was gravitating towards those. Why? Because the banking sector has a knack of getting caned into most crashes or corrections. It's the one that often does get beaten around. And when it comes to bank holders would know this. Banks always get hit. So when you look at the 18, when you look at obviously last year with the pandemic, any of these pullbacks, the banking sector often signals that this is the XLF. We have resistance, failed to breach above the 37 every time when we haven't, it's not over yet, but we haven't done it yet. And at this point, $35. Imagine if it comes down and closes underneath this. That's going to trigger selling off in the financials. And I could see them very easily down at this 32.18, which is going to again be something where we're pushing for a fairly large pullback back to the previous, maybe even resistances of the before pandemic period for the banks. I think this 50 could be the point that we go to though, about that 32. Maybe even lower though. Maybe we spike into that 31.30. So that's just all hypothetical, but this will be one I'm watching. I've got it trapped. There's the levels that we're looking at this week, and we'll continue to pay attention to this one because it's again a precursor to the rest of the market coming into trouble. The Dow Jones looked great. Didn't actually close above this 35,078 kind of zone. Unfortunately, then sold off back onto the daily 20. It looks like it's on around support, and the Dow Jones has a great trend line on it we've been following. We'll update you if I think there's anything going on there. Let's move over to the S&P 500. So again, the community trend line hasn't been hit. So that means that we haven't hit the top end range that we expected. Are we in trouble yet? I would say no. Why would we think we're in trouble when we've just pulled back to a 20 exponential moving average, which we also made a new peak after hitting it the first time? This is not unusual in the market, guys. I know everyone's incredibly fearful, but when every retail trader is fearful, generally the market cannot correct or crash. It's when the dip goes back up. So imagine if I was playing the best game of chess, and the best game of chess is I get you fearful, we push it up. You think, oh, I should have bought the dip. We get you fearful, and then we push it up again. And then you think, and then we set a nice rally into that, and you think, oh, I have to get in. I have to get in. You buy calls, you keep buying calls, and it hits the top, and then it sells off. If that happens, what we're doing is we're basically conditioning you, or Wall Street's conditioning you, to always buy the dip and these little dips that come through. That's fine if you know what you're doing and you're taking the right risk adjustment, but people don't. They lose through this one. They revenge trade it back up. Wall Street does maximum, what we call maximum extraction. And when maximum extraction goes, oh man, does the market get pummeled. And unfortunately, that's what happens to many retail traders. So we'll keep you updated here on the S&P 500. Daily 20 is really all I'm looking at this week. I want to see that thing hold above. And if it doesn't, then we've gone to the 50, because that's the last couple of times that we've pulled back. And that will be a relatively decent pullback there as well. Strange that it would do it before Apple earnings, but yeah, that would be the expectation. Underneath here, straight into the 50 for people that day trade and of course get into a little bit of that swing. Let's have a look now at Bitcoin. Bitcoin is very, very sick. I mean, this is a 4-hour chart. You can see the 20 exponential, 1, 2, 3 touches. I'm watching the all-important weekly candle here, which of course hasn't closed because it trades over the weekend. this is not the best area for it. This would be the first time it's going to close underneath the 50 exponential moving average. And it's got wick rejections all over the place showing bullish intentions. That right now at the time of this recording, it's not looking that great. The only thing you can be happy about, guys, is that when you refresh and you have a look at the BTC shorts here, they have slightly come down. So this is actually a good thing because, or it spiked up a little bit in the last couple of hours. But basically, if the big whales are not shorting it, they're converting into buys, and that's a good sign. I do not want that weekly to close underneath the 50. So we need a rally here, ideally for Bitcoin, fast and quickly. When you're looking at fear as well, usually the market does not pull back or does not crash properly or correct or anything like that when everybody is fearful. And I just noticed this on the fearful chart here. Check out that. The Twitter score, Saturday, July 17th, is 10%. Now, if we superimpose that with S&P 500 like we've done here, if you notice, fear and greed 10%, the market dipped a little, but then it started rallying straight after that. And we had here, it hit 8% after a little pullback, and then it rallied again. So it's unlikely when all of the retail traders, all of us are scared and fearful, that the market can truly fall over. It's usually just a little pullback, buy the dip kind of philosophy is what they do. And then they try to get maximum extraction. Now, time will tell. We'll look at the TA. That will teach us the way that we want to go, but it's usually something I do look at. Now, if we're talking about week ahead data, this is the week ahead. You can always get this at something like Forex Factory, Market Watch, etc. Make sure you do get those types of things. And you'll notice here, we have the OPEC meeting that's going on right now. They're moving towards a deal or something like that. Look, I hate going into oil when there's OPEC. Hopefully oil kind of like solidifies a position soon so we can start looking at that. But in general, this week is looking okay. News-wise, it's not insane or anything like that. Maybe I'm missing something and we'll update you through the week, but I don't think I am. It's just really going to be earnings, and then later on in the next couple of weeks, debt ceiling kind of discussions, and of course the Apple earnings, all important, Apple, Tesla, those types of ones to get that sentiment going through. Good luck everyone this week. I hope you have all the best in the markets, and we'll see you on the Monday live streams and of course the daily videos. Bye for now.